A very good afternoon, everyone, and thank you for joining us for this virtual discussion on Future of Algo Trading, Revolutionizing Backtesting Data. I'm Manmeet from IAMAI, and I'll be hosting the session today. Taking this opportunity, we'd like to give you a quick introduction about IAMAI and our partnering from Refinitiv. Internet and Mobile Association of India is a not-for-profit industry body representing the complete gamut of digital services industry in India. We have over 350 plus Indian and multinational corporations as members from various segments for our sector-specific committees like digital transformation, digital advertising, edutech, fintech, gaming, etc. Refinitiv, a London Stock Exchange Group business, is one of the world's largest providers of financial markets data and infrastructure. With more than 40,000 customers and 4 lakh end users across 190 countries, Refinitiv is powering participants across the global financial marketplace. By combining a unique open platform with best-in-class data and expertise, they connect people with choice and opportunity. We have a distinguished set of panelists joining us today. It is my pleasure to introduce you to Jatin Patni, Director EY, who will be moderating today's discussion. He has over 10 years of diverse quant finance experience, ranging from quant trading for top Indian hedge funds to portfolio risk management and regulatory risk modeling, and leading quant teams across top banks like Nomura and JP Morgan before joining EY as a Director in Financial Services Quant Advisory. Welcome. Mr. Aniket Patni, Market Development, Refinitiv and LSEG Business. Aniket is Enterprise Specialist at Refinitiv and is responsible for managing market data and infrastructure business in South Asia. He has been working in the BFSI sector for the last 10 years and has extensive experience in derivatives across sales, structuring, and trading. Outside work, he has represented India in international level junior chess championship, currently spend weekends playing actively with his beautiful 3-year-old daughter. Mr. Prashant Bish, Vice President Investment, True Beacon. Prashant heads the investment and research team at True Beacon, building on 10 years of experience in the Indian capital markets. He has worked on quantitative and algorithmic trading strategies for both proprietary and client funds, including ST Advisors and Edelweiss, where he was instrumental in building the algorithmic trading group. Prashant has an MBA from IIM Calcutta and a BTech from IIT Delhi. Mr. Vipul Divyanshu, founder and CTO, Streak AI Technologies. He has a decade of experience working on the state-of-the-art AI technologies to serve millions of users. He's the co-founder and CTO of Streak, a platform that is democratizing access to advanced trading technology for the masses. It currently has over 1 million users who have done over 100 million backtests and 10 million strategy deployments across all major market segments. A very warm welcome to you all. I would now request Mr. Patni to take forward the discussion.
Hey Manmeet, thanks for this nice introduction. So welcome everyone to this online event on the topic of Future of Algo Trading, Revolutionizing Backtesting. Just a small disclaimer, all my comments and opinions are based on my personal experiences and they're not official standpoint of my employer EY. Yeah, let's get that out of the way. The goal of today's 1-hour session is to get some real insights into the landscape of algo trading and its most crucial aspects like backtesting, market data, etc. Algo trading is a vast area. It covers technology, infrastructure, research, execution, etc. But we are going to focus mostly on 3 of its most crucial aspects, which is backtesting, the algo trading strategies, and the market data. Right. With this diverse set of experience between our speakers, ranging from algo trading, quant trading in the Indian markets, international markets, also in the FX and crypto markets, the use of ML AI in these areas, and even the insights into OTC and the fixed income space. We have a very good opportunity to learn a lot about algo trading. So let's get started. So my first question is for Prashant Bish. Algo trading is a buzzword, but not everyone in our audience might be aware of what it means. So would you like to give your view on what exactly is algo trading and how is it different from other forms of trading and who can benefit from this?
Sure. Thanks for the question, Jatin, and thanks for the introduction, Manmeet. So let me define algo trading a bit more generically, right? So the way I think about algo trading, and I think that is something that even if you think about decision systems, something that you can think about. So in case of algo trading, it is basically trying to use computational systems to create a relative advantage in data sets, in generating data sets which are better, in generating insights which are better, or doing a better execution. Now that's a lot of things that I mentioned. So let me just unpack it a bit for everyone, right? So the way to think about algo trading is it can help you create. It's a computational system to generate data. So for example, let's say that there is a fund manager who, let's say, develops an application which is constantly monitoring consumer sentiment for a target firm. In my definition, that is generating unique data sets, trying to create advantage. And that is also part of algo trading. Again, that's my personal definition. The other aspect of algo trading is trying to generate better insights, right? So for example, there could be a sophisticated trading firm which is right now looking at satellite imagery to figure out if what the footfalls are around mega stores, right? So they are generating better insights which give them a relative advantage to everyone. And the third aspect is better execution, where let's say, given the fact that there are a lot of providers which give you API access, there is a really smart person who's able to write an application which, while they're working, they're able to execute orders, let's say, saying that, okay, if markets fall by 1%, keep buying. So I think those are the three critical phases of how I think about algo trading. Now, specifically, Jatin, to your question, as to if you look at narrowly, so that's like a very broad definition of what algo trading does. But if you look at the critical and the mainstream use case, which is something that you mentioned, most of the people use algo trading to do primarily use it to generate insights around market using so trying to figure out price patterns, let's say using primarily market data or financial fundamental information, right? So those are the two big sources of information that people typically use. They try to figure out, is there any pattern that they can come up with? Once they have identified some price patterns, and what they typically end up doing is they end up using it to run it through certain portfolio management rules, right? So they run through it, they use simulations. Backtesting is a very important part of simulation, trying to say, okay, how would a signal and a portfolio management strategy, how would it have performed historically, to give you some sense of whether it's making sense or not. So that is what they do. And then eventually, given the fact that there are a lot of firms which can actually send in orders, a lot of people also end up sending these orders directly to the exchange, and the exchanges in India and the brokers in India have done a fantastic job of enabling that. So I think that is kind of the mainstream use case that you would see. The other question to ask is that why are people doing this, right? Whether it's a small or a big firm or individuals, right? So I think it benefits everyone, though I'll mention there is a certain a caveat on that. And the thing is that if you want to run a sophisticated setup, right, algo trading allows you to reduce the research time, right? So time to market, because you have structured data, you can run through, scan through data. You can reduce your time to research. As well as what you can do is you can scale the same idea across multiple asset classes. You can do across geographies, instruments, asset classes, right? And you can ensure that you are doing a great job in minimizing your trading slippages as well as tighter risk control. So I think that comes as a package. Though the only thing just to do is that algo trading is not a solution for everything. Trading is not a very narrow problem. It's got millions of variables, millions of participants. So it's not guaranteed that algo trading will always be better than a human mind. But I think that is the case. And so various people, if they have put an investment from, let's say, a retail trader to a sophisticated firm, can have various benefits given on what investment in terms of time and effort they're willing to put to understand the systems around algo trading.
All right, Prashant. Yeah, thanks for that insight. So yeah, so even in my past experience, I've seen that there are three, like four major category of players in this area. Quant traders who are trying to basically seek alpha from the markets. Then there are portfolio managers who are trying to get optimal execution in the market. And then there are senior leadership like CTOs, CROs who are looking at real-time risk management of their portfolios, etc. Right? So yeah, there are three major aspects of algo trading, as we mentioned, the actual algorithms or the strategies. Then there's backtesting, and then the market data. There are other areas like execution, research, risk management, but we're going to focus on the top three ones today. So as a follow-up question, Prashant, what kind of algo trading strategies are out there?
Sure. So, like I mentioned, there were three areas that are identified, right? You can use algo trading to generate new data set, or generate insights, or generate execution. So, the two broad categories are strategies which actually focus more on generating insights. So let's say we call them quantitative strategies. And there are other kind of trading strategies which are more focused on better execution. So let's call them low latency strategies, right? So again, it is not like algo trading has created completely different strategies, right? It's just that it's enabled people to do some things much better and at scale. For example, in quantitative trading strategies, what with algo trading, what you can do today is, given the fact that there is so much of data, right? You can, which is humanly not possible to scan. Like you have people who are trying to figure out price relationship, let's say by using simple regression at one end, right? So which could be something like a statistical arbitrage that people are doing, to a very sophisticated, let's say a AIML kind of world where they are scanning news articles using NLP to figure out what is the market sentiment so that they can do allocation or figure out like how will people react, let's say, to a certain news, to actually figuring out to stochastic calculus, actually, which is again part of quantitative strategy, where you're trying to, let's say, price options. So that is one set of quantitative strategies. The other set of strategies which focus more on the execution are more around low latency strategies, like I mentioned, right, where it's basically just trying to be faster to market using market data, right, trying to get signals. So, for example, people will try to be fast by building infrastructure and obviously high low latency execution to, let's say, do arbitrage, which could be a very simple example, to, let's say, something like doing high frequency trading where they are trying to use what is known as the market microstructure to predict, okay, fine, so where within this order book, so they don't care about anything else, all they care about that this is how the market is, these are the orders trades, and how can you use that to actually quickly get in, get out, and do this millions of times a day to create alpha. Or it could be just low latency arbitrage where people are trying to manage their liquidity or reduce their impact, like you mentioned, right? So I think those are two broad categories, and within that you'll find there are a lot of these subcategories of different kinds of trading strategies that we can talk about.
Yeah, Prashant, I agree with you. So you covered statistical arbitrage strategies, which are more like mean reverting strategies. Then we have directional strategies based on momentum factors, which might be derived from ML, AI, etc. Then there are high frequency and market making strategies, right? So moving away from the strategies, the second most crucial aspect in algo trading is backtesting. And Vipul, you have created your own products which can do backtesting for retail clients, and more than 100 million backtests have already been done. So what exactly is backtesting? How does it help algo traders? And what are the entry barriers in the area of backtesting?
Okay, so I see three questions there. So first, let's discuss like what is backtesting itself, right? So as it was being discussed, that you have an idea, you have a thesis, right? You have some kind of data that you are collecting, maybe it's market data or alternate source of data. And on top of that, you build some concept to validate that on historical data and to see how well it will perform if the same data pattern repeats again in future, right? That's backtesting, to see basically what idea you have built, will it work, would it have worked over last 1 year, over last 10 years across different market scenarios. Market has cycles, right? Bullish, bearish cycles. So how would it have sort of worked in those kind of scenarios? So backtesting is that specific task itself to validate whether my idea is good or garbage, right? And it sounds very simple, the concept that, okay, what I'm just trying to do is see whether it works. But then to coming to a second question, right, the barriers in it, it's very challenging to do a very unbiased backtesting, right? So before that, to do backtesting, you first need to sort of figure out how do you take all the huge amount of data, store it, do coding on top of that, then find infrastructure, build infrastructure to sort of run fast compute to sort of get backtest data in relevant amount of time. If you have a lot of ideas, it will take, and let's say you take 1 day to code one strategy in Python, right? Just using plain market data. Now you need to do minor changes, add some new data points. You, for just building one strategy, you will end up like 100 or like at least 100 to 100 hours you will just spend on optimizing your code. So that's where the barriers start, and it doesn't just end there. It ends, I mean, there are a lot of things which get involved, especially with regards to biases. That's the next question that you asked, right? People tend to sort of think that like they have all the data that they have during backtest in actual market, which actually they will not have. And in market, you have to take decision at a certain amount of time in a certain given period latency, right? So your backtest will not be able to properly model that if you don't understand those concepts and design your backtest itself well. So it goes back to the concept that, okay, I need to do coding and I need to figure out how to sort of manage, clean this data. Data itself is a big problem to get quality and clean verifiable data from past. Current data, I can go to any sort of website and see, but historical data with proper validity, proper adjustments in regards to stock splits, dividend issues, those kind of things is very hard to come by. So these are the basic things that become a barrier for entry, especially to backtesting.
Yeah. So I remember a decade back, we had to have good knowledge of multiple programming languages. For example, Python to do some data analytics, do backtesting, and then C++, advanced C++ to do actual live implementations, low latency implementations, and multiple other challenges. And I agree that the understanding of tech and infra in this space is one of the major barriers. But recently we have seen this coming up of platforms like even Streak AI. You mentioned that it's a zero code platform. You don't need to understand like in-depth programming, and I think 10 million strategies have already been deployed on the platform. Yeah, so that's very good. So a few follow-up points on this, the proper way of doing backtesting. So oftentimes we see that the backtesting results are not consistent with the live implementations. There are different kind of biases, as you mentioned, survivorship bias, look ahead biases, even assumptions on the execution slippages, etc. So how do you take care of all these elements in backtesting?
Absolutely. So that's a very valid question, right? Especially like when, let's say, you have to do backtest and then do it properly. And there is a saying that if your backtest gives really good result, there is something wrong with your system. It should not give great results, right? It should be more practical in sense. It should not just be like 100% return standard. That's just ridiculous. So the biases. So when we are doing backtesting, essentially as an individual or even as a firm, we tend to sort of think that our objective with backtest is to identify to get good results in backtest, but that's not the actual objective. The actual objective is to sort of be able to test in a much real sense how this strategy would have sort of behaved in actual real environment, which involves accounting for slippages, which involves accounting of how do you prune out all your biases, like look ahead bias, overfitting bias, selection bias, right? Now, each one of them are huge topics in itself, but in a summary, like look ahead bias is essentially you're writing a code or writing a strategy in such a way that it accounts for some information that you will actually not have in real time when you are actually trading. But during backtest, because you have pulled out all the historical data, you have the data, right? So you think that I will be able to have this data in real time, but you actually cannot have that. So in our system, we have designed with like a lot of iteration, a lot of sort of R&D to figure these things out. And we have pruned out look ahead biases, selection biases, and especially overfitting, right? So coming to what overfitting is, essentially you have a strategy, you put some parameters. Let's say you are doing some kind of ML based strategy, and you keep training it with regression to figure out the fine weights that give perfect results with backtesting. But essentially what you have done is you have memorized the past, but that doesn't show that what you have actually learned is something significantly going to identify the future movement of stocks, right? So to avoid overfitting, what we have done specifically is made sure that you cannot enter parameters as a specific value that you can just keep tuning by 0.1, 0.2, 0.3, right? Just to overfit. And essentially, we then also let you backtest on huge amounts of past data over different market cycles to make sure that a strategy which is good and which is meant to work in a specific market cycle, you can take different snippets in time and backtest across all of them to make sure that it's actually picking out a valid alpha rather than just remembering a specific timeline past, right? So that's how we generally you should overcome overfitting biases and make sure that your strategy, even with slight variations in its parameters, with its values, still gives similar results. It should give similar traits, right? It should give similar position sizings and those kind of things. Then selection bias, again, is very common. It's also known as cherry picking, where you basically choose those stocks because, or you choose those indicators which tend to sort of do well in your back test or do well when you are actually testing out strategy, and then remove that. So selection bias, how we in Streak sort of try to overcome with clients is we allow you to sort of do a randomized selection and sort of backtest a lot of stocks at a given point of time, right? So when you do that, you and essentially you then take the whole strategy live. So you essentially are saying that, okay, I am keeping the randomness or it's sort of homogeneous, right? So it's not like skewed towards one sector or one stock that performed very well in past. So these are certain ways that with which at Streak we are sort of trying to help retail clients overcome all these biases, and we have done a lot of work to sort of make sure we put all those checks and balances directly encoded in the platform. So you just come with an idea, you put it in Streak in plain English, you click a button, select the time period, it backtests and gives you the result. And you can do over and over again, and you can test thousands of strategies in like a day. Like in 5-10 minutes, actually, you can do hundreds of backtests. It's very simple.
Yeah, this brings back memory. So I remember a few of my colleagues would come up to me and say that in the backtest, we are getting 700, 800% returns for the strategy. And eventually we would figure out that there was a huge look ahead bias. They were using the next full year worth of history in their backtests. Yeah, so that's that's.
To add to that is many backtests have look ahead biases because they don't account for slippage. If you assume that the time at which the alert or at which the condition is met, if you just take trade at that point of time, that's never going to happen.
Exactly.
We are assuming the best prices you are getting, but that's not the reality. So we account for these kind of slippages, model them, and we also do forward testing, right, with paper trading, and also we get a complete sense rather than just relying on like fancy results.
Yeah. So overcoming these biases and making sure the execution assumptions, slippages, etc., are met are crucial elements of backtesting. You cannot skip them. All right. So the next most crucial element in algo trading after backtesting is the market data. So backtesting is only as good as the quality of market data that is fed into it. So how do we make sure that the data is clean, robust, without any errors? So luckily we have Aniket Patni, who is an expert in market data. He has a decade of experience in trading and structuring. So maybe Aniket, this question is for you. Why is data so important? How to choose the right data set, and like what are the different types of data that are available for backtesting? Again, three questions for you.
Yeah. So again, Jatin, thank you very much. Thank you, IAMAI, for inviting me on this forum, and it is a privilege to be part of the esteemed panelists we have today. So maybe before I come to your question, Jatin, which is a very valid one, I think Vipul and Prashant both have partly answered some of the things I wanted to share, and actually have set me up nicely to what I'm going to say. Maybe I will share a couple of quotes which you may already know, but again, if you must have heard that if you torture data enough, then it will confess to everything that you want it to. So maybe that Vipul has very nicely put in the examples that he has shared already. But one thing which again I wanted to emphasize here, that you have to, as a trader, as a market maker, as an investor, you have to make sure that the data that you are analyzing is robust and it is independent from any biases. That if you have done this, then I think you can completely rely on whatever result that is coming out of it. Now, how do we remove the human element out of it? That is something that probably a trader learns when he actually starts trading in the market. So Prashant also emphasized, and Prashant also quoted one line, that it's a smart human with smart data. So again, emphasizing the data that is important and that makes the human smarter. And that is the whole basis of doing the algo trading and backtesting strategies as well. So you generate insights, that makes you look, that gives you confidence to do whatever you're trying to do. Now you can execute it in a different ways. You can have multiple ways. You can be a high frequency trader. You can have a long-term view and so on. So that is something that is being again powered by data and the kind of data that you have that has gone into testing. Another thing I wanted to emphasize, maybe I will just come to your questions, but again, another thing I wanted to emphasize, which again, Jatin, you have also highlighted, maybe the tech and the infrastructure that is enabled right now. So that because of the tech and the advent of the quantum computing or the new tools that are available that enables you to process humongous volumes of data within nanoseconds, microseconds, you name it, and I think it's doable. Now, with this technology coming in, with this much computing coming in, the value of the data automatically becomes much more, much more emphasized automatically, because if you have the right data and you have the capability of processing this data very quickly, then you can generate those insights and take your call in the market. So that tech and infrastructure part, or maybe the quantum computing part, has really increased the value of the data. And again, another quote that I would like to share, that was again one that was made by CEO of one of the global banks during their presentation, was that 90% of the time, the data scientists who actually implement this data, spend their time on analyzing the quality of the data. So this again emphasizes the value of the data, and that is where actually the organization like us, information vendors and Refinitiv, come in, who ensures that we collate, we capture the right data, and which can be used by our clients in multiple ways depending on their needs. One point I wanted to highlight here again, especially in terms of different segments, maybe exchange traded is very common, and I think Vipul and Prashant both would agree that the information is readily available when something is traded on the exchange. It's available to public, and there are multiple sources who can provide you that information. But the challenges come in, especially at the places where you have disparity. There is no one information source, or there is no one source of truth. There are multiple sources, and multiple sources can quote you multiple different things. How do you make sure that the data that you collect through these multiple sources can be consumed, especially by the institutions when they are making their trading calls? So the example probably I wanted to highlight here was, maybe if I talk about the FX market a little bit, it is a disparate market. There are so many sources of truth. It is not traded on the exchange. And again, it is not because it is not by choice. It is because the way the market is structured. It is mainly because of the credit lines that needs to be there between the counterparties that prevents a centralized exchange-like mechanism for especially OTC products like FX. So here we ensure as a company that whatever data sources that are coming in, we have proper threshold criteria, we have proper checks and balances, so that whatever data that is going and sitting and consumed in our database is highly robust. So again, I can talk about the multiple checks and balances in the process that we have placed, but maybe I will not go there. Now coming to your question, Jatin, coming a little bit late on the different kind of data sets that are available in the market. Let me just give you another quotation that comes to the top of my mind. As if I correctly recall, we currently hold 60,000 terabytes of data in our database. Now, I cannot imagine what the database is like. I mean, 60,000 terabytes, even 1 GB seems a huge data to me, for example. So that much data is sitting there for the people to consume. It is spread across your corporate actions, your references data. Then you have alternate data sets coming in, which Prashant and Vipul both briefly talked about, like, for example, satellite imagery, which helps you, these alternate data sets gets you insights which are not mainstream. That is a unique way or a different way of looking at things, and that helps you generate alpha. Now, again, these data sets are also captured and consumed by our community in various different ways. It can have many different use cases, just not related to financial instruments. But again, there can be multiple uses, consumer uses across there. But again, the point here I wanted to emphasize with this magnitude of data is, how do you ensure the quality? How do you make sure that whatever you're doing is correct or not? And if you're not doing it, then I think you're putting yourself at significant risk. One example, again, I would like to share, again, based on the previous discussion, which again, probably people briefly touched. When you're backtesting, for example, on a particular data set, let me take a real life example of where this situation occurred. So we were testing one index performance against the GDP ratio. So when you do that, it's very normal to take the GDP data for Q1, Q2, Q3, and whatever data that you are seeing in the system, you just simply took it and use it as is. Now, you may get very good results, all fine, that you have got perfect 100% correlation, 90% correlation on the index movement against the GDP. But all these things are fine. The data that is there in the database is also fine. But one point what you have missed in this database, probably to verify here, is when was the data released for that historical data on your backtesting on. So for example, Q1 GDP data, it was released maybe in Q1 at a particular time, which that's a Q1 data, and that's when the market reacted with a lag. Let's say it may be a 2-month lag after which it was released. But even after 2-month lag, the revision, there can be some number which can be revised somewhere down the line. Now, when you see this data, you will only see the data that was captured as a revision data. You will not see the actual estimate that came before it. So your market reaction might have been very different if you have taken into, or maybe the backtesting results would have been very different if you would have taken the initial estimate that has come in into your strategy, and the later the revision has come in, and that's how the market have reacted. Now, this example, I just wanted to highlight that, emphasize the different data sets that are available and why it is important to understand each and every data set that goes into your backtesting strategy, because there are so many dimensions, especially when the data which are contributed or collated from different sources, that you need to consider before you actually make your strategies or trading calls. So these were just few examples I wanted to share, Jatin.
Yeah. No, that's great, Aniket. So a lot of insights. So the major challenges in data being like data volumes. You mentioned 60,000 terabytes. I know dealing with tick level data is already huge. So and then talking about alternative data, then adjustments to data, and again you mentioned this look ahead bias while doing backtesting using the market data. Right. So just one thing you mentioned about FX markets, and you highlighted that so in the exchange traded segment, we have a good amount of clarity in terms of market data. But in OTC markets, especially the illiquid sort of fixed income markets, so what are your views on those areas?
Right. So, I mean, again, a very valid question. Again, building on the fact that OTC markets by nature, they are by structure and they are not by choice. They are there for a reason, because there is a very big element of credit that cannot be incorporated, just like we do in exchange traded, where margin covers a lot of credit risk. That is not typically possible in OTC product, because the credit lines, again, between the institutions who are exchanging hands, exchanging pairs, is very significant. And that is something, I mean, if that can be modeled, I think Russia, there is a Russian exchange which allows this trading. So there is one model that is already there. But generally, most of the FX trading happens in OTC market. Now, in OTC market, let me just emphasize let me just talk about the different participants that are out there. You have dealer to dealer market, basically bank to interbank market in our parlance, we call it. Then you have dealer to corporates, basically the dealer who are quoting to the corporates. Now these are bank dealers. Then you also have brokers in between who basically create their own prices. Then you have electronic trading venues, like for example, Refinitiv has leading FX franchise venue called Matching that is already out there. So there are so multiple venues. Multiple venues can give you multiple indications for the volume that you are trading, for the same amount of volume you want to trade in the market. Now, again, that will also depend on the credit lines you have with your counterparty, and maybe your relationship also matters here a lot. Now, why I'm saying all this thing, particularly from the institution side, is that, again, there are so many different participants who takes into account so many different things that you cannot have a universal number or a universal source of truth that, for example, if I want to execute 10 million in the market, this will be the right price. That there will be a lot of complexities, there will be a lot of factors that can come in. Even when you have the right data set for the right volume, your relationship will be a big factor that you need to consider. Now, this poses a big challenge in the OTC market. And this is where this is the problem we are trying to solve, especially as a company. Now, this is also applicable even to the fixed income trading, where the problem is more pronounced because there are no electronic trading venues. Again, why? Because just like in FX, you have in FX probably you have one instrument, but in fixed income, then you can have multiple instruments. again, on the corporate segment particularly, you can have bonds from different companies, and different bonds can have different credit, different persons have different view on the credit. So these are all models. There is no universal truth. And again, there can be different quotes available in the market. Now, combining these two, FX and fixed income, and treating them as OTC, how do we solve this problem? How do we bring in these different disparate quotes that are available in the market together? And how do we make sure that whatever data set that is being required by the client is available to them? So again, what we are trying to do here to solve this problem is to categorize the data according to the workflow needs. So for example, if you're a corporate, you're basically using FX markets for exchanging primarily, because that is not your main business. So you will just primarily be interested in the passive data, where you can look at the data and maybe execute in the market. So that works for you. So what I mean by passive data is basically the passive algos you can use who are running out of data that is available. So for corporates, it's fine. Now, maybe for the institutions, there is one more angle, which is a compliance angle I will just talk about, which forces the traders to demonstrate best execution on behalf of their client. Now, when you demonstrate, when the regulators wants you to demonstrate best execution, obviously when you're trading manually, you will be always questioned, and you can be held accountable if anything goes wrong on behalf of your client. So naturally, a trader would like to have some strategy in place, or maybe some execution rule in place, so that he can execute without any manual intervention as soon as the order comes in. So that when the client questions him, he can simply talk about the strategy and the algo that he has used to specify the argument that he may put in. So again, the algo trading in the institutions, again, OTC space is being driven by that compliance element. And again, the data set that probably the trader that will use here is very different from what a corporate will look at. A trader may want to look at, again, the every code that is available in the market, the every trade that has been done in the market. And again, he will also like to look at the depth of book that is available in the market. So again, we categorize and segment this data, and we source the data from multiple venues that are out there, and create a package which can give him not the perfect insight, but a much reliable insight that he can use to trade. Now, again, coming to the fixed income, I will just take a couple of more minutes. Now, coming to the fixed income, a very similar problem between the institutions is that there is no quotes available. I mean, the activity is happening in conversations, on chats, but again, that is not captured, not collected. Nowhere there is a database. So everybody has their own view based on the models that they have created. Now, there is no data to power that model. With the advent of the technology, again, you have multiple contribution tool where you can actually capture these conversations that are happening through different channels. If you're chatting on messages, then you can see what are the quotes you can derive. You can pass the data and you can derive some quotes. You can source some data that will give you some insight. Now, there are thousands of conversations happening between thousands of dealers. Now, assuming you have an infrastructure where you can capture these 1,000 conversations, and you can pass this data to derive some insights on the quotes, then you have a live market information that is available to you. Now, that is where we are investing in. We are partnered with a couple of people to actually solve this problem and make life easier, especially for the OTC traders on the FX and the fixed income side. Maybe I have been talking for too long.
Wow,
Jatin, so maybe I will get back to
that's quite insightful, Aniket. I had no idea about the penetration of this algo trading inside OTC and especially illiquid markets. So that's thanks to you. All right, so we have covered three major aspects of algo trading: the strategies, backtesting, the market data. So maybe I would like maybe Prashant to answer what do you think is the future of algo trading? How has this landscape of algo trading evolved in the last 5 years? Do we see a lot of ML AI based algos, and where do you see it headed?
Yeah, so obviously, I think like everything that has been impacted in data science, algo trading is not has been impacted significantly with what can be achieved with ML and AI, right? I think overall, if you look at how the algo trading world has changed in India, to be honest, it's only been I think 12, 13 years since SEBI cleared the regulation to allow everyone to do algo trading seamlessly. So obviously, the initial set of opportunities everyone was going after faster, better execution, right? So for example, there was a time when exchange used to just send snapshot data, and then they said tick by tick, and obviously in a single tick, if you get like which is like in a 1 millisecond, you get 1,000 events, then suddenly it's very difficult for a human to react to that. So I think a lot of focus in the initial set went over there, where people were just trying to do better at execution, and they were just competing against humans, right? So now that landscape obviously has shifted, with people now focusing on better insights. And like again, as Aniket pointed out, right? So market data and financial data is obviously, with a lot of data vendors coming in, cleaning that data. It is something that people use. But now people have started looking at alternate data. And once you start looking at alternate data, the key challenge to remember is that alternate data is high dimensionality, right? So when I talk about market data, it is price and volume. And it's always been price and volume, whether you talk about price and volume of Reliance equities today, 10 years back, or 20 years back, right? But once you start looking at alternate data or even financial information, like dimensionality increases suddenly, right? So how do you understand that, parse that, use it in a meaningful manner? And that is where a lot of techniques that have been enabled by ML and AI, right? And even by putting them onto cloud, right? What you can achieve has been really phenomenal. So, and because now you have got methods where ML and AI can give you insights from such alternate data. It is also that cutting edge where people are focusing a lot of their effort on, right, trying to get that, trying to generate insights out of that. And obviously that is where I think a sizable chunk of alpha is going.
Yeah, yeah. Agreed, Prashant. Yeah, a lot of AI ML based funds have been set up in the last couple of years. I've seen it myself. So Vipul, same question to you, but in the context of crypto and in the context of international markets, like what are your views?
So with regards to AI ML, I mean, AI ML fundamentally in its core, it's pure mathematics and statistics, obviously with some learning and memory aspects being introduced in the same representation, right? More like, so I mean, what we see personally from Streak's perspective and from my perspective, right? We see more commoditization of AI ML. As you would have seen, many of the cloud providers are providing standard AI models for image classifications as off the shelf, plug it and use it kind of a solution. So at Streak, we believe that next 5 years, as and when people become, and our focus is retail traders, as and when they sort of start adopting systematic trading and proper discipline more with Streak, right? We can then just commoditize AI models for various, like the top selected AI models that has been used by quant firms and standard approaches in a more packaged fashion, like plug and play kind of fashion, where they can put in custom data points that they want to use. It can be a combination of market data, it can be a combination of market fundamentals and alternate data. It can also be a combination of same market data, but which kind of indicators and studies you are applying on top of that. So that sort of creates a huge amount of permutation combination that can be done to train a given kind of a network, right? So that's where we see the future sort of develop with adoption of this mindset of following a system-based rule. The challenge, what we see is repeatability with AI and ML, right? Because it mostly, if not done well, it mostly tends to be a black box and you don't know for the same input what you are going to get the output. It's not like every time you give same input, you'll get the same output, even with the slightest variation in a big matrix, right? Even though the image or even though the input essentially conveys the same information. So we have these challenges at which our team is focusing on and is trying to build, because when you have to explain it, when you have to sort of be able to rely on it, it has to be recreatable. And those are some challenges which I think we are very well positioned to sort of solve for retail masses, for millions of users who use Streak going forward in the coming years.
Wow, that's really good. Yeah, I understand a lot of these machine learning based algorithms or solutions are treated as black box, which might not, the retail investors might not be very comfortable with. So bringing in that element of explainability in the machine learning space, that, yeah, that will go a long way. There's another question that is common from the audience, that is around the regulatory landscape of the algo trading.
Yeah.
So maybe Prashant, you want to answer that? What is the regulatory landscape in India or international markets? Just a high level overview. What all is allowed?
Yeah, so sure. So obviously, I think there are some fundamental features of the Indian uh, regulation which are different from international regulation, right? So obviously, uh, the client is regulated through the broker, and the brokers are regulated through exchange and through SEBI. And India, which is very different for the market. So it's always a surprise when you go out, is that there are certain restrictions which are very hard constraints, right? So for example, in outside India, a lot of geographies where you can internalize orders, right? So the order need not even go to the exchange, right? You can internalize orders. There are certain restrictions on the pricing that you can get because it's a fragmented venue. So I think in India, a lot of those issues do not exist because we primarily have two main venues. And within that, obviously, one of the exchanges has a larger market share, particularly in futures and options. So what the exchange has focused on is trying to ensure in principle that they create a shield around investors, right? Particularly retail investors, right? And hence, and again, this is 2008, 2009, till 2008, 2009, actually, you could not send an order without a human intervention, which meant that someone had to actually click an order, even if, let's say, algo generated a buy or a sell. Post that, what exchange and SEBI came up with was that the broker had to actually get an approval for every algo that they're developing, right? And again, the intent is that every algo order has to be clearly identified as a broker. Again, I'm speaking from my experience when I was on the broking side, not on the alternative investment fund side where I am right now. So there again, the idea is that you have algos which are clearly identified by when you send an order actually, and they have to be approved. And there are certain restrictions. And if I remember correctly, as markets have evolved, exchange has put in penalties also for ensuring that people are not stuffing orders, for example. But again, I think a lot of those restrictions are to ensure that high frequency firms particularly don't use a lot more resources and destabilize the markets, right? I think from a retail perspective, I do understand that recently there has been a paper where SEBI has tried to ensure that that retail orders which are algo are directly identified by brokers. So I think that's an ongoing discussion which is happening, which will be very interesting because again, from a control perspective, exchanges and SEBI controls the brokers, and then brokers in turn need to figure out what their clients are doing. And in a very open-ended world, which is where rest of the world is at this point of time, there is no way to ensure that can happen, right? So there is a very fine balance that the regulation has to ensure from an innovation versus restriction, trying to ensure that it's balanced, right? So I think that's at a very high level where we are at this point of time.
Yeah, agreed. The regulatory landscape around international markets, I think Vipul, the Streak, maybe Vipul, you can talk about the capabilities of the Streak AI tool in terms of backtesting and strategy deployments.
Yeah, so I'll just come to that. So as you mentioned, right, with retail, the regulatory sort of guidelines are still very strict. A retail trader cannot automatically send orders in India, even as of date. Obviously, people are finding gray areas and sort of not caring about the guidelines and trying to do it. But at Streak, we take SEBI guidelines and we understand their perspective as well. And we take these guidelines very seriously. And that's why, like in India, with Streak, we send you real-time notifications on your mobile and your website on Streak applications. And all you have to do is single click, right? And based on what we have observed over last 4 years, over like millions of trades that has happened, that actually doesn't change the outcome of your trade. If you take trade at first second or you take trade at 30th second after you got the notification, it is not going to change whether you make money or you lose money, because essentially the granularity of data that you work with on Streak, or in general from a retail perspective, right, from the delay between the broker to the exchange and then it getting executed and all of that, that is more higher than the time that you actually press the button and it goes, right? So that's the current sort of guidelines in India. But internationally, with streak world, US markets and cryptocurrencies, right? They have the infrastructure, and they also have the guidelines or the freedom in that guideline that anybody can punch in any orders. We don't care, right? So essentially, with streak in crypto markets, you can do streak world, you can do full automation. And with specific brokers who have gotten this approval in US markets, again, with streak, you can do full automation, right? Again, there the broker is taking the liability or taking that control of making sure that the OTR, the order to execution ratio, all those things are actually being properly, what exchange expects and what the regulatory body, their FINRA, expects is being handled properly, right? So that's the onus the broker has taken there. Obviously, with the Indian SEBI new paper which had come, a lot of commotion got created. But again, there also they are trying to minimize retail traders' risk, and just by giving that automation, SEBI, in my view at least, doesn't believe that it will sort of benefit traders. It might lead to more towards greed selling and over trading, rather than systematically trading, taking few trades a day, even with a 30-second, 1-minute lag in your order execution, technically would not affect the outcome if your stop losses and target profit are sensible and you're not like doing high volume, millions of trades a day. And obviously for a retail trader, that's not even practical, right? So that's my view on that. And with regards to capabilities and what motivated Streak, as the question that you asked, right, with what Streak you can do, Streak AI's primary focus is how can we enable and bring out advanced technologies that big firms had access to over decades, over 2 decades, in a form factor that can be used by everyday trader, retail trader, right? Everyday trader in the sense somebody who's using charts to trade, who's familiar with markets, who understands what he wants to buy when he wants to buy, but is not able to sort of test that concept, right? And we took that idea, and our CEO, Harsha, he has been a trader for a decade, and he has been like he used to trade by himself, so a retail trader for a decade, right? And has a lot of experience in that. And with him, we discussed how we should sort of go about making it and how we can make it possible. And then we realized that it's a lot of research and development to figure out what stays and what needs to be thrown out, and how can we leverage AI in sort of making this happen, right? So currently at Streak AI, our primary focus is how can we take your English strategies and simple ideas and sort of do it in a much more optimized, I mean, take that and convert it to code, which basically becomes a strategy, which then is back tested and then taken live to market. Right. So, and we support nearly all segments in India, and nearly, I mean, equities in US, options are coming soon in US as well, and cryptos across the globe, crypto futures, those kind of things. And that, again, the core capability of Streak essentially is to bridge the gap between technology and usability, right? You have technology for which you need 20 cons to sit and code 24/7 to build one strategy that a portfolio manager asks them. That we are trying to give in a form factor of a website and a phone, which you, or a phone app, which you can use it anywhere. Any idea pops into your head, you're traveling in a car, just pop out your phone, test that idea, we'll give you results in less than a second, right? That's the core focus, and we use a lot of technologies to optimize that and make sure that your backtests are snappy, backtests are replicatable in live markets, and we cover as much ground as possible, right? Obviously, because this is a very wide domain, the various kinds of strategies, everything cannot be in day one put under one umbrella, right? So over last 4 years, we have expanded our capabilities, and we hope we continue to do that with adoption of more AI-based strategies and more markets and more sort of volumes for clients, right? I think you're on mute, Jatin.
Sorry. So yeah, thanks, Vipul. I think the most interesting part of your insights were how you're trying to break the entry barriers into this area of backtesting, where people don't have to code, they don't have to know programming languages, etc.
They don't
They
have
can
to code, they don't have to manage data, they don't have to
exactly
manage infrastructure.
They don't have to care about these biases that we discussed,
Absolutely.
etc. Right? That's great. All right. So in the interest of time, maybe we can open up for some audience Q&A.
Right. So we do have certain questions which have popped up. So let's start with the first question, which is when should you integrate different modules in a large organization? Because the bugs need to be removed in totality if it has to work seamlessly.
So maybe Vipul, this is you can address this. This is about the availability of different tools. Again, one of the barriers. Yeah, maybe you can
Repeat
talk
the
about that.
question. It was not very clear. It sounded like software development question rather than trading. If you could repeat the question.
It says, when should you integrate different modules in a large organization? Bugs need to be removed in totality if it has to work seamlessly.
Okay. Okay. So if it is directed towards Shreek, the answer to that is, again, because we are building tool from ground up, there is no sort of benchmark or there is no reference point for us to sort of build. It's something that we are building. And Streak, again, you have to understand the person who asked this question, right? That Streak sits on top layer of the entire market infrastructure. So Streak sits on top of the brokers. We have all major brokers in India integrated and internationally as well. And below that comes broker, below that comes exchange. I mean, in between that is the data provider and the data feed, and then the exchange. And any issue in any one of them, like I think yesterday or day before yesterday, exchange was down in around for 10-15 minutes in starting of the market, right? Will trickle effect and I mean will go up the chain and will affect us, right? And essentially will affect you because you are then using on top of Streak, right? Or even if you are directly using with broker. So we sort of take a very hard stand when it comes to quality of adding new features. We don't just rush in. We look at compliance. We look at being able to replicate the results. We look at whether it is going to work in low volatile markets, low liquidity markets, high volatile markets, how is going to work with past data. And we take all of that in account, all the different segments, indicator combinations, studies combinations, and sort of try to do our best to deliver sort of features without any bugs as such. And again, as it is a stack, right? Anywhere any issues comes, you will see the impact with Streak. So, but we have put a lot of processes in place. And even day before yesterday when NSE had a problem, and few days ago when markets crashed due to Russia war, right? At that point of time as well, even though the underlying in the stack things became slightly unstable and more volatile, we stood our ground, and Streak was completely stable with all its features for all its users. So it's a journey, and we are working to sort of make sure that we deliver the best service as possible.
All right, I think that brings us to the next question. With markets acting volatile in the last few weeks, how important is it for an early trader to adopt algo trading and backtest the data before creating new strategies?
Okay, again, I think
Prashant is better suited to answer this question. Basically, how can algo traders benefit in volatile times?
So I think let's look at it just from a backtesting perspective. So one is that during volatile markets, your slippages could be huge, right? So if you can, for example, figure out a way to execute using algo trading, or you can look at market data, you will have a much better estimate as to what slippages you will get, right? Whether it's in terms of signals you're not being able to pick up because the market moved fast. The other important aspect around backtesting is backtesting allows you not only to determine what is the reward of your strategy, also helps you understand what is the risk of your strategy. So backtesting in a volatile market is very, very important to understand the risk of your strategy. So I think so from that perspective, both these, it's very important for people to have some kind of a systematic, whether using algo trading or some other way, to have a systematic view in an active market to be sure that they are able to get decent risk-adjusted returns.
Yeah. So, maybe in the interest of time, we can take one more question.
Sure. It says, how much focus should a backtesting engine give to the granularity of data, like tick versus 1 minute versus 1 day, etc.?
I think Vipul, you are better suited to answer this question. Basically, what level of data granularity is optimum for basically algo trading? Maybe you can give a flavor from retail perspective.
So yes, so the answer to this actually doesn't rely with backtesting itself. It relies with your execution capabilities. Do you have the resources to put an infrastructure in exchange in co-location to get the lowest latency in order execution, right? If you don't have that, anything on tick-based data doesn't make sense for a retail trader, right? So it depends. It's purely dependent on your execution, because as we said earlier, you don't want to have look-ahead biases. So you don't want to backtest on tick-based data, but then when you place orders, you are noticing higher latencies and never getting the price you saw in backtest, right? So it's more important for you to realize what capabilities you have in terms of execution. You are going via broker then plugs into various systems, which are basically trading systems which are provided and approved by exchanges, and then that plugs into exchanges, not directly, right? And essentially for retail traders, I'm saying. Now, keeping all of that latencies in mind, in my view, at least, anything from 1 minute and above makes sense for retail traders. And also, especially in these kind of volatile markets, looking at 1 minute will give you huge variations and fluctuations and extreme amount of noise when you're trying to actually find the signal for taking a trade, right? So you always have to sort of smoothen those things out by looking at multiple time frames at one given point of time and sort of adding studies to smoothen out the data and filter out noise, right? So that's my answer to that.
All right. Yeah. So this was an interesting session, and we learned a lot about the evolving landscape of algo trading and how backtesting can help us, and the impact of good quality market data. It would be interesting to see the future direction of algo trading with respect to how it penetrates the crypto world, how MLAI, etc., penetrates this algo trading. I would like to thank my fellow colleagues Vipul, Prashant, and Aniket for their insights in this area. I'd also like to thank IAMAI and along with Refinitiv for giving me this opportunity for moderating this event, and to our audience for all the questions. Yeah,
Thank
so
you.
feel free to send out your follow-up questions. We'll try to get in touch. Yeah.
Sure. So on behalf of IAMAI, I would like to thank all of you for taking our time to join us today. We hope you all enjoyed being a part of the session. Another thank you goes out to all our attendees as well. I would also like to thank the Refinitiv team for having their faith in us. That's all from us. Thank you, and please stay safe.
Thank you.
Thank you, everyone.
Take
Thank
care.
you,
Bye-bye.
everyone. Yeah.